just the assets. Because with the assets, it's a little cleaner just to make sure everything's closed. That the entity itself will die, the corporation or the LLC. But where you're selling stock, those accounts remain. So, considerations. So as you begin to think about selling your business, and obviously you're going to, some people will try to do this on their own, but a team approach, most of you have worked with trusted consultants for quite some time. So this is just a glimpse of who's responsible for what. You probably are aware, but there are people out there that will do appraisals, buildings, assets. There are brokers out there, some which will do appraisals, some which won't. But those people are going to act very similar to a real estate broker, where they will help market your business. But you've got to find the line between what work should a broker be doing versus what should your attorney be doing. It's a little bit too easy to turn your broker into an attorney, or try to do that. So you think about the different stages and who's going to be helping you. But I think the key thing here is that you're probably going to have to be the one who really carries the ball all the way through this. You're going to have people help you, but you're not just going to be able to hand, and I think that's probably fairly obvious, but you're not just going to be able to hand this off to a broker and say, here, go sell this. They're going to be very reliant on you. It's going to take a considerable amount of your time to get through this. And this may not be a 6-month period. Some businesses it may take 6 months to find a group of qualified buyers. It may take another 6 months to move through the negotiations and the sales. It might take 2 years. And so this is going to consume a considerable amount of your time. As you're putting your time into this, what's happening to sales? That's going to decrease the value of the business. So those are things you've got to think about. So, kind of a timeline, build your team. So one thing is, you'll have your set of financial statements, but those may need some adjustment. And I'm going to come back to that point, because there may be things in there that aren't really the right way to think about the business as it goes forward. I'll come back to that. So marketing, how are you going to market this? I'm going to come back to that point. Put confidentiality agreements in place with people who are interested in buying, and qualify people. Back to that statistic that 3% of prospective buyers actually go through with the purchase. So you're going to have a lot of tire kickers. And you're going to want a process for finding out, is this person really qualified to buy this? You may want to get an account with Dun & Bradstreet and pull their credit, or with the credit agencies and pull a credit report on. Or you may want to work with your banker to pull a credit report on. Because if they've got a 540, they're not going to get bank financing to help buy this business. So you're going to want to qualify. They're typically going to ask you to disclose financial statements for at least 3 years. So what do those 3 years look like? Do you want to show them 5 years? We've gone through 2009 and 2010. Maybe in this case you want to be showing them what your business looked like in 2006 and 2007. To give them some confidence that they can maybe grow back to that level. So there are no rules here. You're marketing, you want to show your business in the best light you can. Obviously there's a negotiation phase. Some kind of term sheet or letter of intent typically be put together with high-level terms. Purchase agreement, probably 5 to 10 pages. Closing. And then you'll probably have to fulfill the consulting agreement that you've negotiated. So this can easily be 2 years from start to finish. Think so? And that's if your business is worth $500,000. What if your business is worth $5 million or $10 million or $15 million? Sometimes that makes it easier, but because you've got a more, it's good and bad, you've got a more easily identifiable set of buyers. But for very certain, it may be hard to get them to the table. Okay, so adjusting financial statements. So you'll start with your net income, obviously, but you're going to want to adjust it. You may be paying salaries to people who aren't spending 40 hours a week in the business, but you may be paying them like they are. So let's add that back, because it's not something I, as a buyer, am going to have to take on. The business might own a condo in Vail. Clearly not a core asset of the business. We want to factor that out of the income statement. Again, the more profitable we can make your business look, show that it is, the higher the purchase price. You know, you might have your Maserati or whatever. Again, let's factor those things out of the financial statements. Does that all make sense to you? So you're going to have a restated set of financial statements that you're going to show the buyer. You may have made some capital improvements, and you may have done some expensing in a way that helped you with your tax benefits, but it really impacts the net income of your business. You may wrote off a lot of Section 179 depreciation. You may want to pull that, take that expense off of your income statement. And these are all things you're going to have to show the buyer your tax return, your regular income statement, and your adjusted income statement, and you're going to have to be able to explain all those adjustments. You know, obviously it's tricky when you try to sell your business because you don't want your employees knowing the business is for sale. You don't want your customers knowing the business is for sale. And so the ads in the local news, in the Trib, you know, that may not be, you know, every once in a while you'll see a for sale, a business opportunity, a retail business in Ames, Iowa, you know, you really can't tell what it is. That's not real effective marketing either. A lot of people will utilize brokers, and that's roughly 10% commission. Is that fair? 10% roughly?
Business is under $1 million.
And if it's over $1 million?
They go by a double Linden's formula, which the fees come down for every $1 million above that.
Okay. So we get less expensive as a percentage, which makes sense. And so now you're going to have your broker who is going to be helping you market. They may have listings. When somebody walks into my office and says, hey, we're moving to town, I'm interested in buying a business, I just won the lottery, I'm interested in buying a business, then we're going to refer them to brokers to say, well, here's somewhere you can go to find a listing of businesses for sale. And usually what the broker is going to do is they're going to interview you, they're going to find out what your interest and skill sets are, and then they're going to try to marry you up. So they're just not going to say, well, here's a listing. They're probably going to try to qualify you in some way. What can you afford? And there are a fair amount of internet directories, Biz Buy Sell and so on, that are listings. You can put in what your interests are and what your area is and so on. Many of these act as an actual broker. They're going to take a commission on the sale. It's a big decision on whether you're going to list online with somebody like Biz Buy Sell or whether you're going to go to the local broker. But and there may be reasons you can't use both. Your broker, your local broker, may very well want an exclusive on your listing. Probably will. So you're probably going to have to make that decision. Does that make sense? Questions? You've been marketing your products and services, and now you've got to think about marketing your business. How are you going to build that cadre of prospective buyers? If you've only got one buyer, you're going to get their price, right? If you've got 6 buyers, then you're going to have some ability to set the price. And too many, I think, in my opinion, too many sellers focus in on one person, and then they negotiate that price to death. And it's just like trying to sell your car. Obviously, the more prospects, the better. Okay, so here's what you're all interested in is valuation. And this is extremely deep, and a lot of variables affect how to do valuation. And there are individuals who have achieved a certification to do business valuation. There are a half dozen different organizations that certify people. They go through anywhere from 3 weeks to a year worth of seminars and training to become certified, and their fees for valuing a business can vary anywhere from maybe $7,500 to $20,000, depending on the value of the business, maybe more. So these folks don't come cheap, but one of those statistics earlier, many businesses are overvalued, and it's why they don't get sold, or why they don't get sold. I had a guy who came in and wanted to buy a business on, this was quite a while ago, but on Welch Avenue, and it was priced at $95,000. A little over a year later, it sold for $32,000. And so in the meantime, it had pretty substantial impact on the business, and maybe if they'd had a little bit better sense of value going into this, it would have been a much, much quicker and smoother process. And I think they would have gotten more value out of it. When you as a buyer see that this business has been for sale for a year and a half, what do you think? What's wrong with it? Right? So you automatically come to it extremely suspicious. Same thing when you look at a house, right? The house has been on the market for a year and a half. You're wondering, what don't I see? What don't I know? Okay, so I'm going to flip this and I'm going to have you look at it from the buyer's perspective. Okay? And from the buyer's perspective, it's, I like the business, but can I afford it? I'm going to switch here. So one of the exercises that I work people through is to think about what is the max value that they can pay for that business. So maybe the business is being offered for $750,000. Can they afford to pay $750,000? Now, I'm not saying $750,000 is the right price, but could they afford to pay $750,000? The reality is that for almost every buyer, that business has got to buy itself for the buyer, right? That business has got to make enough money that they can make the payments to the bank. Okay. So what we'll do is we'll put together a cash flow projection. And I know you can't see these numbers, but this is 12 months for the business. And I'm going to zero in here. So this is a business that is producing cash flow of about $40,000 a year. Okay? So it's paying its owners a reasonable salary. It's paying all the bills. It's growing a little bit. And it's still making an excess of $40,000. So I, as the buyer, I'm going to use that $40,000 to make my bank payments, right? Does that make sense? So it's a real simple question. How much debt can I afford? What kind of loan payments can I make with an extra $40,000 a year? So in this tool, all I have to do is go here. I stick in $750,000, 8% interest. I'm going to try to, the bank wants me to try to finance it over 7 years. And I'm going to come back. And I see that I've just gone, I know you can't see this, but now I'm at a negative $90,000 cash flow by making those loan payments on that $750,000. So I could make a couple of adjustments. I could say, well, the owner was paying themselves $105,000 a year. I only need to pull out $65,000 a year. And now I'm only $55,000 in the hole. So I could go through this exercise and maybe I can make some more adjustments. But at some point I can come back here and I can say, all right, could I afford this business at $400,000? And now I've got $3,500 worth of excess cash flow. So by reducing my salary to what I need to live on, I can afford to pay $400,000 for that business, not $750,000. So this is what I'm going to use as a buyer to negotiate against you as a seller. How can anybody pay more than $400,000 for your business? It's just simply not producing enough cash flow to make the payments. Now, if I could walk in with $250,000 cash I wouldn't have to borrow so much money, and I could afford bigger payments, right? That's going to affect my return on investment. So, but this is a tool, this is the way that a buyer is going to look at it, is what's affordable. So you've got to keep that in mind, is that you've got to create a scenario that somebody can finance. And so if you wanted to look at this, as you're selling your business, turn around and look at it from the buyer's perspective, we could run this same kind of analysis for you, so that you have some sense of that before you start setting your price.
What's a reasonable payback period? You said 15 years in that scenario, right?
Yeah, so to get more complex, what I'm going to do is I'm going to finance your building over 15, and I'm going to finance some mills and lathes over 10, and I'm going to finance some inventory and other stuff over 5. So this is really going to get broken down into multiple loans with different time frames and different interest rates. But, you know, I think, John, tell me if I'm wrong, I would say that if you had one loan on a business purchase, 7 years, 10 years?
7 to 10.
Just seems to be a long time period, given the fact that, you know, business is so typical. And I'm in a service industry, so, I mean, I'm not trying to buy a business, I'm not going to sell, but buy. It's just, you know, 7 to 10, 15-year time period is a long time. I'm just thinking, you know,
Yeah.
3 to 5 years seems more realistic.
Well, I think of a retail business without a lot of assets, and 3 to 5 might very well come into play. So it clearly depends on the base of the assets. What the banker doesn't want to do is have you replacing assets at the same time you're paying off the original loan to purchase those assets, right? So they're going to try to time that all out. So again, thinking about it from the buyer's perspective, this is what the purchase looks like to a buyer. So they're buying some assets, the fair market value of which is $500,000, goodwill. They got to do some improvements when they come in and take this business over, and they need some working capital. So this is how you've asked $925,000 for your business, and this is roughly how it breaks down. Okay, roughly. Of course, you just want one number, right? But I, as the buyer, and my banker have got to be thinking about, well, how does that number break down? So the banker is going to want to see me carry $250,000 into this deal, my own cash. And that's clearly, if I've owned 5 businesses and I've got a great relationship with the bank, that number may be different than this is if this is my first time I've even considered buying a business. So I just threw 25% out there. But how many Gen Xers can put their hands on $250,000? And even if they could, then from the bank's perspective, we've got to be thinking about, well, what are these items worth from a collateral perspective? So I may have $500,000 worth of collateral. And I'm trying to finance about $700,000. Even an SBA loan guarantee probably isn't going to cover that gap. So again, when you're thinking about pricing your business, it's eye of the beholder, right? But for the buyer, it's not just like buying a car. Well, I can afford that car whether it's 15 or 18, but I'd much rather pay 15, right? But when somebody's buying a business, they're going to run into some severe limitations of how much leverage they can get from the bank. And so most of you, your prospective buyers, this is what they're going to be looking at. There's no way that they can finance $925,000. So they either have to beat you way down on the price, and you got to agree to that, or we have to come up with some alternative. And that alternative is you. And that means that you are probably going to have to carry part of the financing load for this business. So here's a scenario. Seller wants $500,000. The Gen Xer's got $50,000. They use that $50,000 plus $100,000 that they leverage from the bank as a down payment. So they write you a check for $150,000, and you're going to be asked to finance the other $350,000. You're just not going to get paid, right? So now the buyer is going to have two payments. They're going to make a payment to the bank of $1,600 a month on that $150,000 they borrowed, and they're going to make a payment to you, the seller, of $4,200 a month against the $350,000 in cash that you didn't get. Now, in order to make this payment work within the cash flow of the business, you may have to amortize that over 10 years. It may have to be set up as a 10-year loan. And you say, look, I want my $350,000 now. I may not, who knows what I'll be doing 10 years from now. So a lot of times what we'll try to do is set this up on a balloon. So the payment will be based on 10 years so that it's affordable. But maybe it balloons at the end of 3 years or 5 years. This means that your buyer has got to get the experience and grow the business and impress the bank within those 3 or 5 years so much that they can afford to borrow the other $350,000. The statistics that I've seen show that the vast majority of businesses that are sold with some level of owner financing. Something you got to get prepared for. Most folks think that they're just going to walk out with that $925,000. It's going to let them buy the condo in Florida. It's going to let them set up a trust fund. That may not happen for a few years.
Yes, Mike, two quick things on this. So banks are very good at kicking the tires on a potential borrower and going through the process of evaluating the strength of that borrower across the table. A lot of business sellers are not. And so just to emphasize the point you made, you really have to, when you're the seller, you're really acting like a banker.
Yeah.
And yet you don't have the same tools as the banker. The other point I want to emphasize is that there's often a competition for collateral. So the bank in your hypothetical is loaning $100,000. They're not doing that without some sense of collateral to protect that investment. You're on the line for $350,000. What's going to be your collateral? Sometimes there's a little bit of competition to see who's going to be in priority for that. That's a tricky point to negotiate too.
I wouldn't be the first guy that bought your business and just drove it right in the ground, right? And I'm selling assets to try to make payroll, and so when you come in to try to foreclose on me, what's left? Is it a business you even want back? But the bank is sitting there, like you said, Tim, with the lion's share of the assets, and they may not even feel all that comfortable with that. They may feel that's a little thin. So, yeah, that's an extremely good point. So I've already mentioned that max purchase price. Some other ways to work through valuation. A common way, I'm saying this is a good way, okay? A common way is to think is multipliers. Had more than one person walk in thinking their business was worth 10 times revenues. And I say something like, well, where did you get that number? Well, I read it, or somebody told me, or it's an industry standard, and where did you. And so there are a lot of myths over what kind of multiplier to use. I'll show you this, but I have this relatively old book, the Handbook of Small Business Valuation Multipliers, formulas. So there are some things like this, but generally the numbers that are in here are based on more sophisticated techniques. So multipliers, I think the point here is you don't want to look at just one method to think about the value of your business. You're going to want to look at 3 methods or so and then begin to think about which one, what's the ballpark? What is the general ballpark? So those multipliers generally are based on like your cash flow. After you've paid yourself a reasonable salary, how much excess cash is left around that you can pull out as dividends, applying a multiplier to that, or applying a multiplier to revenue. There are some rules of thumb out there that are industry specific. A long time ago, I know one guy was valuing a hotel at $13,000 a room. Of course, is it a great hotel in a great location? Is it a rough hotel on the outskirts of town, and all the furniture and so on needs updated. A commonly used method, and there are other methods like this, discounted cash flow. And I just want to give you a sense of how this would work, because this is, again, a very commonly used method. Before I do that, so here's a page out of that book on dry cleaners. And so it's suggesting owner's cash flow, again, the amount that's available to you as dividends, 1.5 to 2 times. So if you're pulling $40,000 a year out of your business as dividends, plus a reasonable salary, your business might be worth $80,000. That's what that's. Plus you get to add to that, the value of a building, anything that is a non-critical asset of the business. So the dry cleaning equipment would go with it, but the building, you could run out of a leased space. So the building would generally be in addition to that value. A key point here is that these multipliers generally are a shock to sellers because they're substantially lower than what you might have come to believe over time. Okay, so discounted cash flow, fundamental finance tool. And to try to make it real simple, so you've got $1 today, and you're going to put it in the bank, and you expect them to pay you $1.03 at the end of the year. And we think about that, obviously, as interest, right? If we reverse it and we say, how much money do I have to put in the bank today to get $1.03 at the end of the year? That's discounted cash flow. I know that sounds incredibly complex, but it's really about that simple. And so here I'm applying roughly a 3% discount. So if your business has the ability to put $30,000 in my hand, I might pay $29,000 for the belief that I'm going to get that $30,000 at the end of the year. But 3% is a pretty low risk rate, right? I mean, you put $1 in the bank, you're pretty sure you're going to get $1.03. But if I buy your business, there's no guarantee that I'm going to get that $30,000, right? So we're going to apply a rate that's more like 30%. So that means that $30,000 is only really worth $23,000. So the way to think about this, there's $30,000 is next year's earnings. It's the earnings that I'm going to make out of this business in the next 12 months after I buy it. I'm going to pay myself a reasonable salary. I'm going to get paid for my time, and there's another $30,000 there in owner's cash flow. So I'm saying there's a risk that I'm not going to get that $30,000. Competitor comes to town, somebody beats the patent, key employees leave the business. So I'm going to say that it's the rate that I need to apply. It's not a low risk rate like 3%. It's a higher risk rate like 30%. So for that promise that I'm going to get $30,000 if I buy this business, I'm only willing to pay $23,000 for that. So instead of thinking of your business as a collection of buildings and equipment and inventory, I'm thinking about this as a machine that produces cash. I don't care about applying the value to all those little pieces. I'm thinking about it as a whole. And I'm thinking that next year, that machine will put $30,000 extra in my pocket. Okay? So now, what if we looked at 3 years? So we do some financial projections. You, the seller, and I, the buyer, agree that reasonable projections on owner's cash flow, $30,000 the first year, $38,000 the second year, and $43,000 the third year. Okay? Does that make sense? You with me? So what are those worth? Well, for this $30,000, I'm only willing to pay $23,000. For the $38,000, I'm only willing to pay $22,000. It's a bigger number, but it takes 2 years to get it, right? And for the $43,000, I'm only willing to pay $19,000. And then with a little bit of math, you and I could agree that maybe year 4 and thereafter, that the business will put $46,000 in my pocket, and I'm just going to grow that at 1% out to infinity. Okay? Mathematically, you can do that. And so what is that stream of earnings worth after the 3rd year? Well, it's worth $160,000. So if I add all those up, that suggests that at a 30% discount rate, I'm willing to pay $250,000 for the critical assets of the business. Plus the building, plus any other discretionary assets like the condo and Vail and that. Does that make sense? There's got to be some questions. Okay. So again, we're not thinking about the business as a collection of pieces. We're thinking about it as a machine. And that machine is going to put this kind of money in my pocket. That's what I'm willing to pay for.
You said 30% the rule of thumb, or you're just using it for an example?
What I've read is that most discount rates, and so let me back up. When you hire a professional and you pay them $10,000 to do a valuation, I mean, one of the big things that they've gone to school for is to learn what is the right discount rate. Okay? Most businesses are probably going to value between a 20% discount rate, relatively low risk kind of purchase, versus 40%, which would be deemed to be more of a high risk kind of situation. So whether it ought to be when some people will do this, they'll just say, well, here's the value at 20, 25, 30, 35. You pick the rate. I'll show you the numbers, you pick the rate. But that's what hiring a professional helps you zero in on. And there are probably some industries that have rules of thumb on what is the right discount rate. Again, by hiring an expert, you're tapping into that database. Is that a fair statement? So again, we're running this 46,000 all the way out to infinity, right? But of course, you can see 43,000, these numbers keep getting smaller because there's more time. So once we get beyond 10, 15 years, the numbers that we're bringing back here are very, very small. Okay, so would you say that's discount cash flow probably when you've got a business that's producing some measure of owner's cash flow, that's probably the most common valuation
It's
technique?
just a piece of the formula we use for all valuations, so we use all that.
Yeah, okay.
It's just-
And you're going to, and any rules, again, you're trying to build a picture and you're going to use multiple formulas. You're going to look at, one of the things your broker's going to help you try to do is find comparables. You want to sell a dry cleaner? Well, what did a dry cleaner in Marshalltown sell for? So again, you're trying to build that arguments to give to the buyers. Why is this business worth this? And so you can go out and you can certainly purchase books like this, and they have a lot of different techniques in here for valuing businesses. But it's easy to misapply those, and I think statistics I've seen is that 10% commission that you might pay a broker, you're probably going to get a multiple of that back because of the better defense you're going to use of your purchase price, the more buyers you're going to bring to the table. So you can look at that broker's fee as an expense, or you can look at it as an investment. Okay, so you got a price now, but you're not finished. So now we start to get into more negotiation between you and the buyer in terms of, and this all gets into your short-term tax scenario and their longer-term tax scenario. So if you have a corporation, again, one way you can sell me that business is I just buy the stock. I'm going to pay you $3 a share. a seller, I like that because I get capital gains treatment. So I don't pay on this income like I don't pay on it like it's income. I pay the much lower capital gains rates. But you as the seller, you don't get to redepreciate the assets. So I'm going to buy your building that's worth $500,000 and it's fully depreciated. Or I'm going to buy that lathe and it's already fully depreciated. I don't get to depreciate it again, like as if I paid 10 grand for that lathe. So you as the seller want to sell me stock and I as the buyer want to buy assets. And so you're going to say, well, the business is worth $1 million, and I'm going to say, well, it might be worth $1 million as an asset sale, but as a stock sale, I think it's only worth $825,000. So it's important to keep in mind that there's going to be a lot of pressure on the price you set once you get to this phase of the negotiation. So you better leave some room for that part of the negotiation. That make sense? Again, if it's an asset sale, that seller might get taxed twice. The corporation would pay tax on the disposal of its assets. It would have a gain on the sale of those assets. And then as I move that money from the corporation into my own pocket, I'm going to get taxed on it again. So again, the fundamental difference between these.
Would it be safe to say that more of a pure stock sale versus, in our business, for example, is primarily stock versus assets, versus a retailer who may have more assets, that basically the value of just a stock sale would be less than an asset sale because of the tax implications?
The more hard assets are in the business, the more depreciable value going forward for me, the buyer, the harder I'm going to push for that asset sale. Because imagine I'm either looking at next year having net income of $250,000 or $150,000. That's the difference that depreciable base is going to make for me. So now, that's worth 20, 30 grand a year to me, maybe more in taxes that I might be able to save by making this an asset sale.
The other risk you have when you buy stock is you don't know what's out there that you're going to inherit.
Right.
Somebody could have a lawsuit pending, could be an employee agreement. There could be a lot of things out there that you're totally unaware of. Maybe the seller is unaware too. You're going to inherit that.
So that everybody could hear, what Roger was saying was that if you buy the stock, you've got the risk that now that business stays alive, right? It didn't die. And so if you, the seller, have damaged somebody a year ago, but they haven't yet filed the lawsuit, that corporation stays alive. Now they're suing me as the new buyer. And I may or may not be liable, but I'm certainly going to have a challenge. So, and I'm going to have to spend money to work through that. So, extremely important point. Now, that's where if you're an employee buying the business, you might feel like you've got a lot. I've been the COO of this business for 5 years, and I got a pretty good sense of what skeletons are in the closet, versus somebody coming in from Dallas, Texas, and they don't really know anything. So again, even if we can agree that it's going to be an asset sale, we're still not done. Because is that building worth $600,000 or $400,000? The IRS might be comfortable with either one of those numbers. But if I get to depreciate that building, I want it to be $600,000 as the buyer, right? So how the breakdown, both of these total $1 million, but how it gets broke down to each one of those assets is again something that we're going to negotiate. And both of us, seller and buyer, are going to have a lot at stake on tax issues. So again, having a tax attorney and a CPA involved in helping you think through this is going to be critical. So that goes back to that team. What kind of team are you pulling together? And that leaves us about 10 minutes for Q&A. So any questions or any insight that folks would like to add? Let's go with questions first.
Like you said, most of the people in small business are 55 and older. We have very few of us, I'm not going to very 5-year exit plan. What do you recommend? At what point you think, hey, you know, there's something that I feel is valuable, you start working on that?
I think one of the key things, I've seen a lot of people get shocked by what they thought the value was going to be versus what, they think they're 6 months from being out of the business and they realize the value is more like this. And now they see that retirement is 5 years or 10 years away. And then they begin thinking, well, if I'm 5 years away or 10 years away from retiring, maybe I should have replaced that piece of equipment. Or maybe, and so had they realized what the real time frame was, they would have managed their businesses differently. Maybe they would have hired that marketing person to replace the other person that left. So they could have kept sales going like this instead of maybe like this. So I think first off is having a realistic expectation of value. And then saying, okay, how does that jive with my retirement plans or my go get a new job plan? And then you can begin for the next 5 years, you can begin managing your business with a better expectation of what you're likely to take out of it. Another key point, I think it's just more, it's just really having a sense of time frame. It helps a lot of people. Would you add anything to that?
Well, yeah, most people that see us, they don't have that plan in place. They're there because partnership dispute, divorce, death, want to move to Sunbelt, something like that, or employment. And they haven't put together, this plan. And so, value and all that stuff depends on, what they're doing. But, yeah, you got to sit down and kind of figure this all out and start looking at that. Again, 3 years is nothing.
Yeah.
You look at it. And one of the things I was going to comment, anybody's thinking about selling, we've had customers that they get mentally checked out of their business once they got a buyer that has shown great interest, or maybe there's an offer on the table, and they're working through due diligence. And again, like you said, it takes maybe 6 months, maybe longer, depending on the size of the company. But they're mentally checked out. And I've had more than one company that because they mentally checked out, their sales dropped, their profits dropped, and if the bank wants to see the current stuff on a quarterly basis, if that thing is diminishing in all those numbers, you've got a problem. Probably that business won't be sold. It's happened more than once. So, but just stay focused on the best thing you can do is keep your numbers up and run your business like you're going to sell it in the next 3 to 5 years, whether you do or don't. But run it like that.
Yeah. What kind of employee base do you want to have to try to showcase that to the buyer? And I had one guy who said, if I would have realized that I was 5 years or more away from selling this, I would have given that guy the $5,000 raise he deserved. So again, I think understanding time frame has a lot to do with how you're going to manage, whether you think it's 6 months or 6 years. And obviously, you're going to do things differently.